next paper is going to be looking at social responsibility, but through the lens of investors and looking at, causal chains, I guess. Our speaker is Davidson Heath.
Thanks, everyone. It's a tremendous pleasure to be here in person, and thanks very much to the organizers as well, and thanks to Ellen for agreeing to discuss. Exactly as highlighted by Rui and Luis's paper and many others, there's this kind of renewed debate in the last few years about the objective function of firms and funds. And there's this, we've departed from the Friedman 1970 classic viewpoint that managers need to simply maximize. The business of business is to maximize shareholder value. And starting most prominently with the Hart and Zingales 2017, there's this idea that firms can undertake kind of stakeholder capitalism, this broader idea of shareholder welfare or even stakeholder welfare. And there's sort of an ongoing debate, right? There's no question that investors care a lot about, I'm going to use SRI, socially responsible investing, so that hopefully I avoid the whole discussion about what to talk about. I'm just going to use the term SRI. Here are stocks and flows into SRI firms. We've all seen this graph. SRI investing is hot, okay? On the other hand, there's a debate as to whether there's any sort of effect in practical terms, right? Tarek Fancy, the former head of sustainable investing, I think, at BlackRock, right? Sort of famously said, came out and said, ESG investing, he now actually, his tagline now is ESG investing does more harm than good, because his view is that it is a placebo. The wonderful story that he recounts was that he was flying to somewhere in Europe to pitch the new ESG funds from BlackRock, and the client said, so how will, when I put my money in these ESG funds, how will that actually improve the environment? And Tariq Fancy seemingly, he's telling the story, but still, he said, I don't really know, actually. And the sales representatives from BlackRock who were there with him, pulled him out to the back of the plane and said, shut the fuck up. Stop talking, don't say that, right? And now he's the former head of sustainable investing at BlackRock. And the former head of sustainable, I think, investing, Stuart Kirk, if I'm not wrong, gave this kind of cri de coeur about climate risk and climate investing at the HSBC summit, and he's now apparently the former head of sustainable investing at HSBC. So, but Tariq Fancy's point, more harm than good, though, he argues, is because it's greenwashing, it's a pure, it's a sop, it's a placebo. And that's why he argues it's more harm than good, because it distracts us from doing things that could actually make a difference, okay? So it's not entirely clear what SRI funds, they're very popular. There's papers like the Hartzmark and Sussman showing that these things are popular, but it's not entirely clear what, if anything, is actually happening when you invest in SRI funds. So we that's the empirical exercise in this paper. We think there are three main possibilities that we want to distinguish between. Are SRI funds literally just identical to non-SRI funds, and it's just 100% greenwashing? Do they select green companies in their portfolio, but they don't have any effect on corporate behavior? Or do they improve corporate behavior? These are maybe not completely exclusive to each other. So what do we find? We find very clear evidence that SRI funds do select better behaved companies, okay, with better SRI score, better ESG scores, and better real behavior, okay. But we find zero evidence, fairly tightly identified, that SRI funds don't have any effect on firms' actual behavior on a variety of ESG type outcomes. Okay? And I apologize, this was not, these are like new results in the last week or two. So we have a couple of new tables where we're delving more into the mechanism. So I'll talk about those very briefly. Lots and lots of papers on the investment side of et cetera, including Nick's fine paper and et cetera, like we talked about. There is a fast-growing literature, of course, about finding that institutional ownership is positively associated with SRI outcomes. My colleague Carl Linz at Utah has this paper. There are these other recent papers. Those are not so tightly identified, I want to say. So they find a positive association. And really, part of the job we're trying to do this paper is trying to unpack that and tweeze it apart a little bit better to get at the causal, et cetera. Another Ganchev, Janetti, and Lee paper, they're multiplying like rabbits. And of course, the main question for any of us these days, as social scientists, is a topic is only worth investigating if Elon has tweeted about it. And there's a wonderful series of papers, including Cornelia, who was here yesterday. I don't see her here today, but Cornelia has a lovely paper, and there's a series of papers saying, what even are these ESG ratings and these various ESG metrics? And as Cornelia alluded to, there's a lot of question about how stable and meaningful these scores are, okay? And in fact, this tweet was, which I found pretty funny, was on the occasion that Tesla was dropped from S&P's ESG compliant firms list, although Exxon and a bunch of other oil companies stayed on the list. The funny story here was that I found was when journalists called up the S&P 500 ESG committee and said, what could Tesla do? I mean, it's literally an electric car company. What do you want it to do differently so it could get back on this ESG list? And they said, well, they don't spend very much on investor relations, and maybe they should do more of that. And so it was like, oh, okay, like, you'll create an actual electric car company, but you're not taking the ESG people at S&P out to dinner enough or fancy enough dinners so they get dropped off the index, right? Okay. So, like I said, we're trying to talk about what effect do SRI funds have. It's quite difficult in some cases there's a lot of different options and definitions as to what constitutes an SRI fund. You see these gigantic numbers saying that there's like $10 trillion that are somehow ESG investment, right? But those numbers tend to proceed from counting lots and lots and lots of funds that like say, oh, we consider ESG, or ESG like matters to us. They say some sort of boilerplate in their prospectus, or they've said something along those lines. We're going to take a union of 3 lists that are a little more, a little harder claim, hopefully. So we look through Bloomberg and Morningstar socially conscious fund list, and there's this forum for SRI, for sustainable, SFI or SRI or something it's called, okay? And so we take a fairly broad union of lists, prominent lists of ESG funds, sorry, that in some sense have done more than mutual funds and ETFs that say that they explicitly are ESG oriented, and that they have a dual mandate. Okay. And so we have a variety of outcomes, real outcomes, right? We're interested in real outcomes mainly for this reason, right? We're concerned that actually looking at sort of ESG ratings of funds and firms, it's really hard to say what does that meaningfully amount to, right? So this is the main reason possibly why we're interested in real world outcomes. And in each case we're going to make, first of all, we're going to run this association and just run this regression to say, what's the relationship in the cross-section between SRI investment and SRI behavior? And then we're going to try to tease apart the causality. Is there some sort of causal relationship underlying it or not? Problem, endogeneity. Firms can take actions that jointly affect, et cetera, et cetera. Different firm policies can attract different types of investors. Maybe the investors are picking firms that are on a downtrend, but they're going to, mean revert, right? It's just very hard to disentangle that. So our solution is to get an exogenous shock to SRI fund capital using this Morningstar fund ratings, star ratings trick. This is star ratings, let me be very clear, not globe ratings, okay? So that distinction is important. So the star ratings are that every month, I think, Morningstar assigns all the funds in their database a star rating based on their 3, 5, and 10-year risk-adjusted returns. It is difficult for funds to manipulate where they are. I had a mild coronary when I read the Kim's, I think it's his job market paper, because the title is like, funds are manipulating their Morningstar ratings. And I was like, my paper is ruined. But then if you actually read it, the gravamen of the article, of his paper, is he says, funds used to manipulate their Morningstar ratings up until about the mid-zeros, but now they don't anymore. So I was like, that was a big, that was really nice. Okay, and so what we do is we construct a matched list of matched sets of firms. We think this is an identification strategy that can be applied to other problems. So we're looking forward to that. But this is the first application we thought of. We construct a matched set of funds that land on either side, thank you, Jennifer, on either side of a ratings cutoff, okay, of a star rating cutoff. And so they look really similar in terms of all of their sort of other things we can think to test them on, okay? These are from paired t-tests, not just two sample, but actually paired t-tests. So that's a fairly stringent, test of statistical significance. You can see the only difference really that shows up is their difference in terms of they're exactly 1 star different by construction. Now, what about the forcing variable, which is the 3, 5, and 10-year Morningstar returns that go in? Here's the distributions of the treated and the controls. So you can see, like, any statistical test is gonna say, I can't tell that these aren't drawn from the same population, the same group, right? So we're fairly pleased about that, okay? So we find 3 years pre versus 3 years post, the matched sets of funds. The funds that got the bump in the star rating have about a 23% higher AUM in the post-treatment, which is a lot of money. These are, on average, relatively small funds you saw, 900 million in assets under management. So these aren't like the giant funds, okay? But we see a 23% difference. If we residualize with respect to a whole bunch of other stuff and just get the residualized AUM, it looks good. It passes a falsification test. This is the event time graph, the diff and diff graph. Looks pretty good. This is a stacked cohort event study framework. So you want to do Abraham and Son to check. So we do Abraham and Son to check. Everything goes through. We're like, okay, cool. We're au courant, okay? So we're going to compute the fitted value of that using that, I think actually the 21.3, the third column there. We're going to multiply it by the fund's ex-ante holdings. It's holdings just prior to, in the quarter prior to this change in the treatment period, okay? And that's going to give us a fitted shock based on the fund's ex-ante holdings and this shock that we argue is exogenous because it could have ended up on either side of the Morningstar ratings cutoff to have 4 stars or 5 stars, for example. Okay. So what do we see? First of all, let's see the cross-section, the relations in the cross-section, just the associations. The associations look like the following. Here are the EPA, the pollution-related outcomes, okay, including the Sautner et al. Climate change exposure. And you can see across the board that just in the broad cross-section, SRI funds hold firms that have lower pollution and lower exposure to climate change risk. So, okay, something's happening here. Thumbs up. This is consistent with the Linz et al. And the other sort of cross-sectional evidence, right? Yeah, so I'm going to make Holger very happy here. We're concerned because we're testing these associations and the outcomes on like about a dozen different outcomes, right? So there's an obvious multiple testing problem here that you would expect at least one of those if we test 12 outcomes to load at the 10% level. And every couple of times that we run it, we should see something loading at the 5% level, right? So we're going to use this wonderful Romano and Wolf multiple testing correction. So that's really the row that you should look at. And statistically, these are fairly strong relationships. The bottom line. It's a little weaker for employee satisfaction and employee safety, okay? But there is still some evidence that across the board, they hold firms that have happier employees and safer employees. Okay. They hold firms, there's no difference in racial diversity, but there's a small but significant difference in gender diversity on the board. Okay. So overall, thank you, Trevor. And unsurprisingly, if we then, I said we don't want to hang our hats on any particular ESG metric, but if we use the KLD scores and ESG scores, we see, yes, they hold significantly higher rated firms, higher ESG ratings. Okay. So something is happening. SRI funds do invest in accordance with their stated principles. Okay. What's happening when we use these fitted values from these exogenous shocks to say how much of that relationship, if any, is actually causal, that they're actually affecting their portfolio firms? And the answer is, like I said, you can focus on here for the p-values, the Romano-Wolf corrected p-values, nothing across the board. Most notably, we don't want to perpetuate the cult of the p-value. So let's look at, let's say total releases. Notice in the aggregate, in the cross section, the association was minus 25%. The causally identified, the shock-based identification is 0.3 in the positive direction. So if anything, it looks like an exogenous shock to SRI funds flowing into firms leads them to be slightly higher polluting is the point estimate. And moreover, you can see the minimum detectable effect size is a measure of the size of a treatment effect that we could reliably detect if it were there, okay? And that's 12%, so we could detect. Our null results are not a result of low power, statistical power. We could, in principle, detect something that was there on the order of the association if it were there, but it doesn't seem to be, okay? Similarly, results are, sort of not showing up at all in terms of employee welfare. In terms of gender diversity, before correcting, it looks like something's there, but after a multiple testing correction, it goes away, statistically speaking, and that's a very small thing. Here we go. This is fun. So the shock-based identification of fund flows of SRI funds into their portfolio firms is actually followed by, if anything, lower ESG scores coming out of KLD. Now, again, I don't want to hang too much of our hat on that because, as Cornelia has pointed out, these things get back propagated and readjusted every quarter or something like this, and they're very, very unreliable potentially. But if anything, it goes in the wrong direction that you would expect, okay? So these results suggest that SRI funds are all selection and no treatment. So why? So this is the stuff that's kind of new, and I don't think it's even in the most recent version of the paper. It's in the last week or two. So we're going to look at how do they engage in terms of their voting at portfolio firms. And I just want to point out that, I really like Sean Davies and Ed Van Wessep having a JFE from a few years ago. And of course, there's this recent Burke and Van Binsbergen paper. Both of those papers are arguing on a more of a theory-based grounds that simply holding green firms and divesting brown firms is probably insufficient to have any effect on firm behavior. So therefore, the other channel that we would like to sort of close off or check is engagement, which is best measured by, the best we can do is ESG-related shareholder proposals. So here's our shock-based regression on a number of outcomes like this. And you can see that the main effect on number of ESG items that actually passed and fraction of ESG items that actually passed is, if anything, negative when they get. Thank you, Jennifer. So, and I don't have the Romano-Wolf in here yet. I apologize, I got to run that. It's a bootstrap thing, so it takes a while. But so I don't know if these will remain significant after multiple testing correction, but that's it. So some caveats. Why should you maybe not believe these results or not think that we're really delivering the answer? Well, we're looking at quite a narrow, small set of capital flows. So this is the motivating picture that I showed that we all look at the start of every SRA paper and say, yeah, it's really popular and it's booming and all-time highs and so forth, right? Notice the assets under management, the flows part, for ESG funds, this is the Morningstar report. It's just under 150 billion. Now, 150 billion is a decent amount of money, but in terms of overall US equity markets, it's a tiny drop in the bucket, right? SRI funds as a whole, at least according to our definition, hold way less than 1% of the market cap of any given firm in the data. So it's relatively small. So you might expect that they can't have an effect at this ownership level. What's more, of course, SRI, we're testing year plus the outcomes the year afterward. So let us just test like T+2, T+3. That's the best we can do. That's going to pinch down our sample because we're using, we're using observations further in the future. But we find no evidence across any of these things that things are sort of picking up and happening with a delay. Okay. So overall, SRI funds do invest differently than non-SRI funds do. They hold more green firms, and they do offer investors a portfolio that's consistent with their stated objectives. That's where all of the association is coming from, as far as we can tell. They have no underlying relationship. They have no underlying effect, treatment effect, on either SRI scores, ESG scores, or on firms' actual environmental and social behaviors. Okay,
Great.
thanks.
Thanks so much, Davidson. Our commentator is Ellen Quigley.
So first, thanks to Colin and Elaine and Suzanne for organizing an amazing conference. It's great to meet you all. I'm also conscious that I'm the main barrier between you and lunch, so I'm going to try to keep this snappy. And what I'm going to do is, because we got quite a good overview, I think, of the content of the paper, I'm going to canter through the summary and then go through some quibbles and then get to the meat. And in the meat, I'm going to talk about how this paper could potentially underpin some regulatory complaints. So I think this is a really important paper. I'm really glad it was written, and would really like to see it fill some of the gaps in the literature, which tends not to focus on this question. So just to summarize quickly, so this paper uses some of the same Morningstar discontinuities that we looked at yesterday to look at inflows, and the effect that inflows into ESG funds have on real-world environmental and social outcomes. And I think one of the other important things about this is that it does look at real-world outcomes, and the indicators are pretty good at actually detecting whether these companies are changing their behavior. And then you've got some pretty good tests and checks and so on. So you've got, looking at 2 to 3 years out post-treatment. You've got, comparing funds with the same ratings just to check to make sure that the discontinuity effect is there. Accounting for SRI inflows more generally and whether that could account for the results and so on and so forth. So really good to see that. That said, just a few of the quibbles to start with. So I think probably just breaking out some of these indicators would help, because I don't think that, for example, board diversity is a measure of employee satisfaction. So you just put that separately, I think, categorize it differently. But actually, speaking to the employee satisfaction, so the workplace injuries, I mean, they're quite severe, violent injuries, like amputations and hospitalizations. It'd be good to look at those within sectors, because obviously if you're working at Microsoft, it's pretty unlikely you're going to have an amputation related to workplace. And some of these ESG funds will have tilts that are within sectors, so you'll want to just make sure to account for that. And similarly, actually, for pollution. Again, like Exxon is in a lot of these funds, so you want to just account for that. For climate risk, I'm not sure whether there is a better measure, but I wonder about analyst calls as the indicator for that. And you might want to just look around and see if there is some other measure I like how that kind of checks against the other real-world outcomes that you look at, but it might be good to see if there's something else. And then just a quick question, is it only dioxin and dioxin-like chemicals? Okay.
You mean for the total output, or?
Yeah, because when I read it, it looked like those were the only things that you were detecting, and I know there are quite a lot of different types of chemicals and releases and so on that you might want to.
Yeah, no, we use all we put
Okay,
in
so,
all cancer-causing chemicals.
All cancer-causing.
All potential carcinogens, I think.
Okay, but not like emissions.
I'll have to check. I'm sorry.
Okay, so I would recommend including emissions as well, since that'll be one of the main things that you'll want to.
Yeah.
Yeah. Okay. And then yesterday, we talked about Morningstar ratings and how the movements tend to be at the top end and the bottom end, and yet your mean is in those middle ratings. So based on yesterday's discussion, I would just recommend maybe breaking out the top and bottom and just seeing if you get different results from those, since there's more likely to be movement there. The time period you use is an interestingly weird time period because it happens to be a period in which fossil fuels underperformed the market basically the entire time, for example. You've also got the period after the financial crisis when green investments had kind of lost the confidence of markets. So I'd recommend, I realize you're then getting into the manipulation of star ratings, but if you could at least go to the financial crisis, or as far as you could go back towards when the manipulation happens, and then as close to the present day as possible, because the other thing, as you kind of saw in the graph there that you showed, already 2019, you've got an almost exponential rise in adoption of ESG funds, and that's gone up and up and up and up and up. So updating the paper, I'd be really curious to see what that gives us. Minor point, the 4.5% extra on abatement, it makes it look like that's the amount extra that's being spent, whereas it's really just like an increase in the number of types of abatements that are mentioned. But by the way, I'd really love to see what types of abatements are mentioned, because I think one of the strengths of your paper and one of the things that we have to dig into to make it extra strong is what are the real world outcomes, and companies have a habit of mentioning things that sound good but don't actually match up with real world abatement. So really good to dig into that, give examples. Are these actual real abatement efforts, or are they things that they think the regulator might want to hear or that people might want to report on? And then, yeah, so as we heard yesterday, really interesting discussion about the various definitions of ESG and so on and so forth. I think you'll want to, and I'm sorry, I'm just recommending a whole bunch of things that'll be a lot more work, but just running it according to, like if you're looking at the environmental elements, you might want to look at the SRI funds that are on climate or environment specifically and look at those effects, and also those that make impact claims or engagement claims and see whether they behave differently broken out from the broader group. By the way, that also links with the point I'm going to make later about regulatory claims. And then just an illustrative side note on BlackRock. So you link to their 4-page document about engagement. And I would encourage anybody who has a degree in English literature to go and parse the sentences in any BlackRock report. It's really quite funny how little actual content is and how they're kind of circling issues. So what that 4-page document actually says is we're asking companies to disclose more. But you might get the impression, if you don't read closely, that they are actually asking for some of these real-world outcomes that you refer to. They are not, from reading that document. So I think, yeah, especially if you want any kind of amusement, read through those documents and parse them. It's quite fun. Okay, so now let's get to the meat. Because, as I say, this is a really important paper. And I think that it's going to get a lot of traction because it's going to be useful in the real world. So I think that it's important to look at the mechanism. And I actually think this is the part where I think your paper goes a wee bit wrong is towards the end when it talks about what the implications are. So what is the mechanism behind the results that you find? So it's what your paper is really showing is that the inflows are into the funds, but the companies aren't getting extra money from this. Like these are secondary market investments. So it's really that the proportion of shareholders in these companies is now a little bit more ESG. That's what you're looking at. It's not actually capital inflows into the company. So that's important because that helps to explain why you don't see any behavior change. Because then the mechanism for change would have to be, that the companies care who's on their share register. I think they kind of do, but it's hard to argue that that will result in any kind of near-term behavior change on the part of the company. Whereas there is quite a body of literature that's growing that looks at the differences according to asset class. So there are several papers that look at primary market capital inflows into companies. So new bond issues, IPOs, et cetera, they'll tell you something that probably is intuitive to many of us, which is that if you have more demand for a bond issue or for an IPO, you can raise more money at a better price. And the opposite is also true. If you have less demand, you have higher cost of capital and you can raise less money. That's really important. That's your mechanism. And so, I think it's important to kind of note in your paper, this is about public markets. This is about the secondary market. This is about public equity, the effects could be expected to be different, or at least there's a plausible mechanism by which the results could be different in other asset classes. And I note that the one instance in which you mentioned bonds, it's about ESG bonds. And that doesn't get at the question, because the same companies that are going to have, Exxon could issue an ESG bond, right? And it's hard to explain the mechanism by which their having issued an ESG bond would actually influence their behavior change. Even sustainability-linked bonds, don't let me get into this because I could complain all day. But it's hard to explain the mechanism by which an ESG bond or a green bond or whatever is likely to change the behavior of a company, or especially because the demand for those are already quite high anyway. But if you look at industries that people are trying to avoid, the effect on costs of capital, and especially the kind of growing awareness of that, you do have cases in the real world in which, like, for example, Adani trying to build the facility around the Carmichael mine, had to build a much smaller facility than planned because they couldn't get that financing at a reasonable cost. So they had to kind of self-finance. These are real-world mechanisms that you could hope to find by looking at those other asset classes. And the implications are huge, right? Because what this paper does is it helps to explain why ESG doesn't work. Because most ESG funds are public equity funds. And that's really important because there is a lot of marketing around this. Frankly, it also calls into question the efficacy of engagement, as you say. I was really happy to see that you've added some stuff around that as well. Because it also, and this is probably the most important, it explains why we're still seeing trends accompany an increase in ESG investment that you would not expect to see if it had any effect. So if you look at a graph of emissions, it's going up. If you look at a graph of inequality, it's going up. You wouldn't expect to see that if ESG did anything, because it's gone up quite a lot in that same period in which we've seen these societal ills also increase. So that's why this paper is really important. It says, this is kind of an explanatory, or part of the explanation for why we're not seeing any effect here. But where you go with it at the very end is to say, well, maybe these companies are, maybe what we're doing is engaging with or selecting the wrong companies. But I think that's wrong for a couple of reasons. So one is, again, like Exxon is in many of these funds, right? If you're going to pick a company that has, environmental issues, Exxon would be on that list, probably at the top of that list. So already many of those companies that you would think of are in there, but also that doesn't address the mechanism, right? So even if you included, even if SRI funds concentrated heavily on the companies that could be changed, what your paper says is there's really no mechanism for that change to happen. There isn't any new money flowing into these companies. It's not affecting their cost of capital. Even the engagement doesn't seem to be helping. So it doesn't really map onto this argument that if they just picked different companies, there would be an effect. And I think that's quite important. And also then there's this reference to a working paper looking at patents. I've about 6 critiques of that paper, so we won't get into that. But I just think it's important to instead of getting into that side of things, build on the strength of your paper, which is real-world indicators, and ESG doesn't work, and here's why, and here's the mechanism, and maybe reference some of those other the other findings from other papers that suggest that this might be different, where there is actual reallocation of capital as opposed to just reallocation of ownership stakes within a company. So that's very important. Finally, so I said that I would talk about how this could be become part of the basis of regulatory complaints. And it's precisely because in the paper you mentioned that about 66% of these funds have an explicit claim around impact on company behavior. And that is wrong, your paper says. Those are false claims. And actually I'm just going to reveal that I've had arguments with BlackRock about this. They have funds that they label as impact funds, and I've asked them an awful lot of questions about the evidence they have to back that up. And the evidence to back that up is not robust, whereas your paper provides evidence on the other side. And I could see this paper actually contributing in the real world to claims of regulatory complaints that helped actually improve the greenwashing, or rather, actually, I was going to suggest that you start using the term impact washing for your second point. So greenwashing, then impact washing. Anyway, this paper could help meaningfully address the impact washing that we see all over this field. And frankly, like that's my central complaint about ESG, about this whole field, is that it's mainly public equity, mainly secondary market, mainly has no effect that we can detect. And your paper is a really meaningful contribution to this, because I think it does quite a good job of telling us the ways in which this is the case. And I think you just need to get into the mechanisms and tighten up some of those indicators, and we will have a really, really strong tool to actually effectuate real-world change.
Thanks so much. So Davidson, do you want to respond to some of Ellen's comments? Although it sounds like you're perfectly in sync.
Yeah.
You want to say something, and then we've got a queue starting up. I think it's Dirk, Holger, and Elizabeth.
Yeah, the Canadians, we all communicate telepathically. So Ellen already sent me her comments, and I have responded graciously. No, thank you so much, Ellen. Really, really fantastic. And geez, the real world. That's very high praise. Thank you. Yeah, so in terms of, okay, so specific things. So on the emissions thing, I have to check, but my Danny Machoki, my dear friend and co-author, will be able to sort that out, and we will say more carefully what we do to construct those measures. Morningstar stars, should we look at the top and the bottom stars? Yeah, so I forget if this is Diane Del Guercio's paper or the Reuter and Zitzowitz paper, but there's one in the paper where they explicitly check, and they find that it's all in the 4 and 5 star thing, and like very little of the effect lives in the 3 and 4 star, or the 1 and 2 star, or the 2 and 3 star cutoffs. And so we thought about that, but we also want to squeeze as much statistical power as we can, and we didn't want to get into the weeds too much. But it's worth looking at for sure. The time period is weird and sucky. I sort of agree. We can try to extend it backwards, and we can certainly extend it forwards. But academia being what it is, that's the only reason we got to 2019, is because like we started this project years ago. Dig into which types of abatements. So the abatements, to be clear, most of the outcomes except for the weird Sautner et al. Climate risk measure, all the other environmental measures come directly from the EPA. So those are actual abatements that happened. And so, but we can dig into further like which facility types and what they actually did. I think that's wonderful. Let's see. Yeah, I think that's a terrific idea. Dig into SRI funds that have different mandates. Yes, I think we have to go back, as you say. It is, and I'm going to steal impact washing. I think that's amazing. Thank you. So, in fact, that could be the new title of the paper. The current title is kind of unwieldy and shitty. So, impact washing. That's the new title. Thank you. Yeah, and in order to get into that deeper, I think digging into further what funds are saying they're doing and what exactly is in their mandates is a great way to kind of really dig into that deeper. So I think it's terrific. In general, thank you so much. This is super, super helpful.
Okay, let's go to the questions. Let's have two first, Dirk and Holger, and then we'll have Elizabeth and Rui, and anyone else put your hand up if you'd like to join the queue. Dirk?
Yeah. So this identification strategy you have is super clever.
Thank you.
And as you said, could probably be used a lot for different things, but I need just a little bit more convincing that it's powerful enough to actually pick anything up in the end. Because, rudely, what you showed us as the first stage isn't the first stage. Right? What you've shown us is that once the shock happens, your treated funds get 20% more money, which is great. But the actual first stage would be, do the shares, your treated shares, those shares previously held by those same funds actually get a sizable inflow, or a sizable change, not inflow is the wrong word, apologies, a sizable change in ownership, those SRI funds actually owning more shares. And there are at least two things that could noisy that up, right? Number one is those same funds could be taken at 20% invested elsewhere in different companies. Secondly, and probably less likely so, they could be buying the shares from other SRI funds. So the net SRI ownership just basically stays the same, right? So you kind of need to show us how much the SRI ownership of those treated firms actually goes up. And then nastily, if that goes up on average from 1% to 1.1%, then I think most of us would be going, okay, fine. And you wouldn't really expect to see a major change in behavior afterwards, and we kind of know why.
That's great, thank you. We did.
We'll take Holger and then.
Good.
This meshes with that. I am also skeptical of much of the ESG stuff, but I playing a devil's advocate here. If we're going from 1% to 1.1 or whatever it is, this is like the run up, and giving them the benefit of the doubt. Once they get to 10%, 15%, whatever, they might actually have a real impact. So, practically speaking, one thing that you might want to do, and I don't think you have done it yet, just look at how those funds vote. I mean, you've shown us, okay, the aggregate outcome is, the resolutions don't pass, but, minimum condition for them doing anything is that they actually put their votes where their prospectuses are. That's one thing you can actually explicitly check.
Great. Yeah, thank you. So in terms of the first stage, so we have checked regressing actual changes on the fitted value, and it loads a ton, and the coefficient's like 0.8 or something. So we have something there. In the end, the change in beneficial ownership is, you're right, like on the order of less than 1%, which sucks because you're right. Maybe we wouldn't expect to find anything yet. It's kind of hard to know how to get at that, given that on average these funds hold as a class, they hold like less than 1% of the typical firm. They are tiny at the moment. And so until we get to 10% SRI fund ownership, it's kind of hard. So we do have something in the paper where we split into, on the basis of, because some firms do have higher SRI ownership, ex ante, for example, and they get a bigger shock. And we find the same thing. But maybe we can we probably need to do as much as we can on that side, because you're right, that's a fundamental limitation that is imposed on us by the world.
Yeah, thank you so much for the paper. Really interesting, and Ellen's comments also. I'd like to offer a comment that comes from a corporate law and governance perspective on this, where I think it might be helpful to what I understand as a finance project, and it amplifies and maybe sharpens Ellen's last comment about what you're saying about your conclusion, which is that you say that your results suggest that the SRI funds are successful in giving investors the portfolio of environmentally and socially responsible firms, but they're not changing the behavior. And then you say, hence, investors who want to change the real world behavior might be investing in the wrong firms. And Ellen was saying that's bothering her because that's what makes people think ESG doesn't work. But this is where I think it really is very important to come in with some clarity around the terms and the expectations, because it's not just that it might be that you're not changing the activity. That might not be why. I don't think your conclusion is following, because the investors might not even be in the wrong firms. They might be in the right firms if what they're trying to do is align their values with what they're investing in. It's a different thing to be trying to change the activity. And those are all falling within, like in the slide that I had yesterday, of what's coming under that umbrella ESG. And SRI is even an older term that came to mean a different purpose. So I want to commend to you Ron Gilson's great paper that's co-authored, and it came out a few years ago from the corporate law and governance literature, how investors can and can't create social value. And what they do is they offer a taxonomy of socially motivated investments so that investors could try to more clearly articulate what their goals are. Is it just to align my own values? Is it to change the activity, et cetera? So that the asset managers could be more clear. And I think that that means that it really would be important to spotlight the part of your paper that's about what those asset managers are actually claiming about these funds, because that's where the crux of the problem is coming in some sense, because we can exist in a world where there's lots of different goals and expectations that are being served by different financial instruments, but if the problem comes in where the expectations aren't meeting the terms. Yeah, thanks.
Yeah, that's terrific. Thank you, Elizabeth. Yeah, you're right. I think Ellen and Elizabeth have given us a really nice path forward to say what are they actually claiming that they're going to do, and then what are they actually doing. And I think that will clarify. That can clarify the intro, the conclusion, and everything in between. So that's really helpful.
Yeah, I think that's a great comment, Elizabeth. It reminded me also of, the literature around the, 2002 about cross-listing and sort of, you would attract people that had the same values, that it mattered. Rui.
On the mechanism, like, why is it that trading on the secondary market shares that are actually already out there would matter for the company? If you think that there's fewer individuals trading the other firms, right? There's changes in liquidity, and we know that changes in liquidity affect how firms behave, respond in many different ways. So, whether related to executive compensation, better incentivizing managers, and things like that. So that's one mechanism. But there's also another hypothesis, which is a segmentation hypothesis, which is, if fewer investors are trading the non-ESG, non-SRI, related stocks, then there's more risk concentration on those stocks, and there's the cost of capital goes up for those, the cost of capital goes down for. So there's mechanisms that are out there. I don't know that these mechanisms work in the time frame that you're thinking about, or given Dirk's comments and Olga's that the size of the effect that you're capturing is sufficiently to capture those mechanisms, but they're.
Yeah, thank you. That's worth, that's really a comment for Jonathan Burke and Van Binsbergen and those guys, right? Because those are alternative ways where divestiture could have this kind of indirect effect on firm behavior, right? So that's a problem for them, not a problem for us. But yeah, it's worth saying that there are other proposed or conceivable channels through which it could have an effect, but we just don't find it.
Yeah, and actually, I think I've got a related point actually, which is one of the channels could be that executives who act in a way that they think will cause investment by SRI funds might believe they'll get a share price blip from doing that, which affects their compensation, and that wouldn't be picked up through your identification strategy.
Out, if our identification strategy is ruling out some of the things that I'll call emitted variables or reverse causation, then if you call that an impact of the fund, on the other hand, that's like they're doing it in an effort to attract SRI investment that hasn't happened to the firm yet, right? So it's difficult to say that that's an impact. That would be difficult to measure, it seems to me, if you thought that strategically they were going to respond to the fact that SRI funds exist and I would like to attract.
I think it is, but Alex Edmonds and I can't remember the co-author, they've just brought out a paper looking at tilting as a potential mechanism for real world impact. I'm skeptical about whether it would have a real world impact, but it's just a theoretical possibility, I guess.
Terrific, thank you.
We've got Nick, Eric, and you want to say something, don't you?
Yeah, sorry,
and do you want to say it immediately, Ellen?
Anytime.
Okay, well, we'll go with the guys that have got the mics, and then we'll turn it to you, and then over this side. Nick.
Okay, so I was going to mention Alex's paper about divestment, since you like Ed's paper that much, so you should cite it. But the other thing is, I wanted to know a little bit more about the way you construct basically the identification. And my question is about how do you deal with the history of the star rating? So they have the 10, 3, and 5, 10, 5, and 3 years. And it's kind of a slow-moving process, right? So a fund can possibly predict, based on their past returns, whether they might actually drop or lose a star. And since I believe you're matching on your SRI fund, let's say, has a 1 star lower than the other fund. Do you do something about that, since you're really trying to make this identification really strong and popular? That was my question.
Terrific. Thank you.
I wasn't going to say anything, but I'll just sign on with Team Tom over there. On some level, like if you were to sit down and take this paper and say, I'm going to write a gigantic theoretical model of this paper, there are two things going on in this paper. There's incentive provision and there's matching that's going on. All right? Your paper, I think, is saying match first, incentivize later. But that doesn't have to be the case, right? And so I almost kind of feel like, well, when am I going to try to just, do my work on, on SRI metrics? Well, maybe a point I may have incentive compensation, baubles coming due. I may have capital needs coming due. That's the point in time, if I'm going to do a secondary offering, that I'm going to actually want to have a robust market out there. So I do all of that work ahead of time. But it's because I know there are these pools of capital. It's not gigantic, but they're looking around. In fact, they did this with some other company 6 months ago, and that company's been flagging. They're looking to move their money anyway, so why not come to me? So I do kind of wonder. I think about modeling this, and I think the matching and the incentivization could come in either order. And I almost wonder whether you could run the second set of regressions just backwards in time.
Yes, exactly right. I think that we could run the exact same set of regressions backwards in time and see if there's evidence. What we would want to look for is evidence that fund managers are catering, given that they see some possibility of attracting more SRI investment, right? And so there are tests of catering. A lot of them are pretty terrible. But we can try to think of a nice way to get at this question of our fund managers catering. And I agree, that's 100% an important possibility that we need to check.
Ellen and then Ron.
Okay, sorry, this is probably inappropriate. Come back in, but by just a few quick points.
Go for it.
Thanks. Okay, awesome. So one, just a point on the voting behavior, just a caution on that, because if you actually trace back again to real world indicators, I was disappointed to see the results from voting behavior. Even when things pass, they tend to be disclosure only, and then the implementation rate is poor, blah, blah, blah. So just a caution there. To Rui and Tom's point about public equity impact. So yeah, it does feel like there are several mechanisms that could lead to company level behavior change. But I mean, I reviewed a lot of this evidence for the University of Cambridge divestment report and looked at both fossil fuel divestment and apartheid South Africa. And it's just really hard to find evidence that traces this stuff back to actual changes in behavior. Like I'm really not convinced on the basis of having looked at a lot of papers in this space. So I agree that there are plausible mechanisms there, but like in the empirical evidence, they just don't tend to show up. Whereas in the theoretical literature, that's when you get into like the higher percentages of penetration of SRI funds. And I think the people behind those theoretical models would argue that we just haven't reached those thresholds yet, and it will be nonlinear, and we probably won't see really any effect until quite far along, and then we might see something that looks kind of sudden. So just to say, it's kind of complicated, but I'm really, like, the difference here is that you have observable effects where there's primary market activity. You can see already in the empirical evidence that there has been an effect on cost of capital and so on and so forth, right? So that to me says that one mechanism is already strong, even with low rates of penetration of ESG or SRI. So that just seems kind of important when we look at this.
Let's go to Ron.
Just a quick comment. It doesn't get easier when you're doing when you look at the private equity funds in this space. They're typically blind pools. TPG ran a $3 billion blind pool impact investment fund. You're not in a position to be able to tell the investors what it is you're going to invest in. So there are a set of structures that the private equity funds have used to deal with that. And it's worth taking. It won't match. It won't read entirely on or much at all on the secondary market, but the techniques have been successful to move a lot of money, and they're useful, and they provide some guidance, or at least some ideas about how to go about it.
Thank you.
Any responses to those, Davidson?
Yeah, no, just excellent points in general. And yeah, I think we hope that we did a decent job with the evidence that we have, but there are some other bolts to tighten and other hypotheses to check. And the question of this nonlinear pitch that if we get beyond 10 or 20% or whatever it is, then suddenly the age of Aquarius will be ushered in is interesting, but the universe has not given us a way to test that yet, I think.
No, you don't go to an auction. So I'd like to thank Davidson for a great paper. Ellen, thank you very much for your commentary, and thank you for both reminding us that sometimes what we do actually has relevance in the real world. I think that's important for us all to remember. Thank you.